Here is a question most people never ask. If you put aside just $1 every single day and invested it, what would you have after 10 years? Most people guess somewhere between $3,000 and $4,000. A few optimists say 5. The actual answer, with the right account and the right approach, is closer to $6,500 from $1 a day, and that is before you factor in what happens if the market has a great decade. But here is the part that really matters, because it's not about the number, it's about what the number teaches you. This is not a video about getting rich quick. This is a video about understanding why small, consistent actions produce results that feel mathematically impossible, and using that understanding to change what you do starting today. Let's build this from the ground up. Let's be precise about what we're measuring. $1 a day means $365 a year. Over 10 years, that's $3,650 total that you put in. Not a dramatic amount. In fact, that's less than most people spend on coffee in a year. But here's where it gets interesting. We're not going to leave that money in a drawer. We're going to put it somewhere it can grow. And the place we're putting it matters enormously. Option 1. Keep it in cash. Your $3,650 stays exactly $3,650. Inflation actually makes it worth less in real terms. Option 2. A standard savings account. At today's average of around 0.5%, you end up with roughly $3,740 after 10 years. Barely any difference. Option 3. An S&P 500 index fund at its historical average of around 10% per year. This is where the number changes completely, and this is what we're going to track today. The S&P 500, the index that tracks the 500 largest American companies, has returned approximately 10% per year averaged over the past century. Not every year, but averaged. And that average is what turns $1 a day into $6,500. Let's walk through this year by year, because the beginning is the part most people give up on. After year 1, you've put in $365. With 10% growth, your account shows approximately $383, barely more than you put in. Year 2, $730 in. Account value around $804. Year 3, $1,095 in. Account value $1,268. At this point, if you only look at the total you've put in versus what you have, it feels underwhelming. This is where most people stop, and this is the worst possible moment to stop. Year 5, you've put in $1,825. Your account holds $2,344. Now the gap between what you contributed and what you have is starting to open up. Year 6, $2,190 in. Account $2,978. Year 7, $2,555 in. Account $3,776. Year 8, $2,920 in. Account $4,653. Year 9, $3,285 in. Account $5,628. Year 10, $3,650 put in. Account value $6,530. You put in $3,650. The market gave you $2,880 for free. Nearly $3,000 you never earned, never worked for, never had to ask for, just because you were consistent for 10 years. Now here is where the $1 a day experiment gets genuinely shocking. Everything we just showed you assumed a 10-year window, but compound interest is not a 10-year story. It's a lifetime story. And the difference between starting at 22 and starting at 32 is not 10 years of results. It's something far bigger. Person A invests $1 a day from age 22 to age 62. Total invested, $14,600. Final value at 10%, approximately $198,000. Person B waits until 32. same dollar a day, same 10%, same retirement at 62. Total invested, $10,950. Final value, approximately $76,000. A 10-year delay, same habit, same amount, $122,000 difference at retirement. Person B did not waste money. Person B simply waited, and waiting cost $122,000. Here is the psychological trap that kills this habit before it starts. Trap 1. It's only $1, it won't matter. This is mathematically incorrect. The dollar on day 1 is not worth $1. It is worth every compounding return it will generate for the next 10, 20, 30 years. The first dollar you invest is the most valuable dollar you will ever invest because it has the most time. Trap 2. I'll start when I have more. More never comes. The version of you with more money has more expenses, more responsibilities, more reasons to wait. The habit matters more than the amount. Trap 3. The market is too risky right now. This one requires a reality check. The S&P 500 has never, in its entire history, failed to recover from a downturn over any 15-year period. Not the 2008 crash, not the dot-com collapse, not COVID. Over any 15-year window, it has always gone up. The only risk in investing is not being invested long enough, and waiting because the market feels uncertain is the exact behavior that guarantees you miss the recovery. Here is the exact practical setup for the $1 a day experiment, or the scaled-up version that makes more sense for most people. Step 1. Open a brokerage account. If you're in the U.S., Vanguard, Fidelity, and Schwab all offer no-fee index fund investing. Takes 15 minutes online. Step 2. Find the S&P 500 Index Fund. VOO, SPY, and FXIX are the most common, all essentially identical, all track the 500 largest American companies. Step 3. Automate it. Set up a weekly transfer. Even $5 a week is $21 a month, $252 a year. Automate it so you never have to think about it. Step 4. The hardest one. Do not touch it. When the market drops 15%, and it will, multiple times over 10 years, the wrong response is to sell. The right response, if anything, is to celebrate. You are buying shares at a discount. Every dollar you invest during a market dip buys more shares than it would have at the peak, and when the market recovers, those extra shares multiply. This is not theory. This is how every market millionaire has operated, not by being smarter, by being calmer. Now let's scale this up, because once you understand the mechanism, the only question is how much of it you want to use. $1 a day, $6,500 over 10 years, $23,000 over 20 years. $5 a day, $32,600 over 10 years, $116,000 over 20. $10 a day, that's about the cost of one coffee and a cheap lunch, $65,000 over 10 years, $233,000 over 20. $25 a day, the cost of a mid-range restaurant meal, $163,000 in 10 years, $583,000 in 20. Same market, same mechanism. The only variable is how much you put in. The most important question this video can leave you with is not, where do I open an account? It is, where is the money already going that could be going here instead? Not to punish yourself, not to eliminate every enjoyable expense, but to audit, to choose, to decide which daily habits are worth more to your future than to your present. For most people, the $1 a day, or the $5, or the $10 already exists, it just has not been redirected yet. 4 things, that's all you need. 1. Start small. The amount doesn't matter as much as the habit. $1 a day is infinitely better than $0 a day. The habit is the foundation. The amount scales up naturally over time. 2. Start now. Not next month, not when you get the raise, not after you pay off that thing. The math we just showed you makes the cost of waiting undeniable. Every day you wait is a day of compounding you never get back. 3.
Automate it. Remove decision fatigue from the equation entirely. Set the transfer, set the investment, then let it run. 4. Stay in. The investor who does nothing during a market crash beats the investor who reacts almost every time. The question this video asked was simple. What happens if you invest $1 every day for 10 years? The answer is $6,500, but the real answer is something harder to put in a number. The real answer is you become someone who invests, someone who understands compounding, someone who has made the decision that future wealth is worth more than present convenience. And that's worth considerably more than $6,500. You came to this video asking what happens if you invest $1 every day for 10 years. Now you know the number, now you know the mechanism, now you know the cost of waiting. The only thing left is the decision. If this video showed you something you didn't know before, hit that like button and subscribe. We break down one financial concept in every video in a way that actually makes sense, and share this with one person who needs to hear it. Because the best time to plant a tree was 20 years ago, the second best time is tonight. See you in the next one.